Nancy Prial, if you don't mind, I'm going to begin with you. I want to get your reaction to what we're seeing in the futures. Seeing futures move higher after a very volatile day that ended lower, with tariffs on steel and aluminum beginning today, European retaliation beginning today, also seeing China push back on one of our biggest U.S. companies.
Well, we've had a relentless sell-off in the market as we've coped with the fear of the tariffs on, the tariffs off, coming through earnings season, worries about stagflation, recession, et cetera. And so the market is ripe and due for some kind of relief here as the selling really got pretty intense, what we saw on Friday and certainly throughout the volatility yesterday. So we've been thinking that we were going to have some kind of a bounce here, have some relief, have some thinking about the fact that there really is still a lot of growth opportunities in the U.S., even in this heightened trade war risk and heightened environment. What we don't know yet is if this is really the return to a bull market, or is this simply a bounce off the bottom, catching our breath, and then we go on and end up making new lows. So the jury's still out on that, and the determinant will be inflation and growth.
You know what? I think Nancy Prial, I'm coming over to Nancy Tengler now. That is a good question. Did we hit the bottom? Is this a bounce off the bottom? Nancy Tengler, in your mind, do you think that now investors feel like pretty much everything is priced in? The 50% threat of a tariff on Canadian aluminum steel, really a shock to the market, but then things kind of calmed down. They did end lower, but do you feel like all the tariff threats and the concerns, do they seem to be priced in? Is that what we're seeing this morning?
That's a dangerous question, Frank, for me to answer because I, of course, don't know. But I do think we're getting close to a bottom, if not already there. And the reason for that is at some point, investors just become immune to all of the chaos, really, and they start focusing on the fundamentals. And I agree with Nancy. I think there's a lot of good news out there. We may be in a decelerating growth environment. I don't think we're going into a recession, nor do I think we'll see stagflation. But in a decelerating growth environment, you do want to own the reliable growers. And so we added to some of those names on Monday. It was hard to do. We sort of held our noses and jumped in. But I think we'll be happy with those purchases in a year or two.
All right, so you don't think we're headed towards a recession. Nancy Prial, I want to come over to you now. You believe that actually we're going to see a GDP contraction, maybe even deeper than the GDP now estimate that's out of about 2.4%. Also, we have Goldman trimming its year-end S&P target, citing increased uncertainty over the president's policies. I want to ask you, what does that mean when it comes to small caps and other parts of the market outside of mega cap tech? I know it's your wheelhouse, the small caps and the mid caps.
Right. Well, this will be a challenging environment for the small cap indices and for that broad small cap market, just because of the number of loss-making companies in the index and those that don't have the balance sheets to withstand what will either be a slower growth environment, 0.5% to 1% kind of GDP growth, or possibly a few quarters with a modestly negative GDP print. We're not expecting a deep recession. We do think there's a chance of 1 or 2 quarters that could tip negative. Within that context, however, of a somewhat more challenging overall small cap environment, we think there are a tremendous number of opportunities for picking stocks in small cap land. And small cap is in one of those areas where index investing really doesn't work. It really pays to be a stock picker, to find companies with good balance sheets that can generate cash, that can grow quickly on both revenue and earnings, and that have the tailwinds of some of the exciting areas of infrastructure spend, Internet of Things, AI, et cetera, behind them. All
right. Nancy Tengler, coming over to you. You are, in fact, a stock picker. I want to talk to you about the Mag 7. So our data team, they crunched the numbers for us just to show how big of a drag the Mag 7 has been on the S&P in March. I'm looking at the charts here. Mag 7 down more than 9% in March. You see right here. 6 of the Mag 7, the biggest drag, the biggest negative impact on the S&P this month. You've made some move in the Mag 7. I want to ask you, do you think we've seen the bottom when it comes to these mega cap tech stocks that have really powered the market?
I do, Frank. I mean, we've heard the end of the tech trade for the last 3 years. Every time the stocks pull back, we hear, okay, it's over. But it really strains and the mind to say, okay, these companies aren't going to grow anymore, because in fact, what we are seeing is that they continue to deliver double-digit growth. I mean, we added to Tesla and NVIDIA on Monday, both names for different reasons. But NVIDIA is growing this year, this fiscal year, at 50% and is trading at 26 times. So on a price earnings to growth basis, that ratio basis, that's the kind of company that we want to own in a decelerating growth environment. I don't want to be overweight consumer staples at 22 to 25 times next year's earnings, and they're growing in the mid to low single digits. So I think this is one of those opportunities. Remember, Microsoft was trading at $220 a share in October of 2022. That was a time to step in. It's never easy to do, but these companies have a lot of levers to pull. They have robust balance sheets, and free cash flow, even after all the CapEx spend, is going to continue to be strong. And don't forget that what we're seeing in the economy is productivity is improving, and unit labor, we got a better than expected productivity print for the last quarter, and unit labor costs of about 2.2. So those are compelling numbers. We think that can continue for a long time.